Alrighty, well, hello and welcome to our 2022-2023 federal budget recap. And what does that mean for you is a subject that we're presenting today. My name is Peter Shun. I'm one of the partners at Canars here in Rockhampton. I've also got along today Jake and Tom, two of our financial planners as well. This podcast or this recording is also being podcasted out to 125 Years in Counting podcast. So welcome to all those listeners as well. And it's also on a YouTube channel for anybody listening in the future, as well as anybody who's watching this pre-recorded as well. So essentially what we wanted to run through today was a bit of an overcap of the budget, what that means for you. Wasn't anything too exciting in there last night. Even though that might not be the case from an accountant's point of view, there's a couple of little things in minutiae that everybody sort of needs to know and needs to be aware of from there. So there'll be a survey at the end of the webinar as well. So please, if we do send that out via email, please answer that. And also, if we can make sure that we stay on mute for the duration of the webinar, that would be awesome as well. Questions at the end will be great. So any questions that we've got about the budget, that'll be fantastic. But apart from that, Jake, Tom, and myself will go you through what our recap of the budget was for this year and what that means for businesses, for individuals, for retirees, etc., from there. So obviously it's myself, Jake, and Tom, a couple of the young boys from the Canars Financial Services team, which is subbing in for Brent today. So Jake's a financial planner and Tom's just passed his, is it 8th subject, Tom, I believe, is that correct? Or so you're a provisional financial planning.
Yeah, I passed the advisor exam. So now I've got my P plates on for the next 6 months, basically.
Yeah. For the next 6 months. So Tom's going to run a few things through with us as well, which will be fantastic also. Yeah, as I said, please keep any questions for the Q&A session at the end, and we'll go from there. But the big thing was there was a couple of key personal income tax changes in the budget, which will help out ordinary Australians, low and middle income earners from there. The big one is essentially what is known around circles as the Lamington, or what us accountants know as the low and middle income tax offset. So the low and middle income tax offset was essentially pegged at $1,080 for the last couple of years. There was some strong rumours that would be not available anymore, but the government, obviously chasing a few votes and wanting to win an election, their jobs back, has one-upped it and gone to $1,500 for the low and middle income tax offset for this year only. So the Lamington essentially stays for the 2022 year, but after that, the low and middle income tax offset won't be available at the moment as it stands. So it's $1,500 for individuals, and essentially what happens from there is that is treated as a refundable tax offset on your income tax return. So if you pay tax, for example, of $4,000 for the year, the low and middle income tax offset of $1,500 will come off that, and you'll receive a $1,500 refund plus or minus whatever deductions or income you have from there. If you received a low and middle income tax offset in the past, you'll get the full benefit of the $420 increase. So it's not a sliding scale upwards or sliding scale downwards or anything from there. So it's the original Lamington, or the LMITO, plus for this year only, they'll add $420 on what you would have received in the past couple of years. Good news is that anybody from essentially no income tax to $37,000 receives an increase of $420 from what was $255, but it's still capped at $126,000 per family from there. So if you receive above that, there's no low and middle income tax offset. The other thing which was a bit of a sneaky through the budget is they've slowly increased the Medicare levy low income threshold for singles, families, pensioners from there. So there are only slight increases, but it's more of a cost of living increase whereby if you're a single person, your current income is 23,365, you won't have to pay a Medicare levy, whereas before that it was from 23,226. So it's slightly increased, but not by a great deal, but it's more of a cost of living increase for the Medicare levy threshold. So Medicare levy is 1.5% of your taxable income. One of the big pressures that the government was under at a certain point in time was to make sure that COVID-19 tests were tax deductible. A lot of people had to have COVID-19 tests and pay for them themselves, like RAT tests, to ensure that they're able to work. So from the 1st of July, which is essentially the next income tax return, you're able to claim the costs of your COVID-19 test expenses. Obviously, making sure that you keep receipts from whether you go to Chemist Warehouse, Coles or Woolworths. If an employer was to pay for the RAT tests, then there's no FBT on that, and it's fully deductible to the employer as well. So they've just made essentially the COVID-19 test expenses blanket deductible if you're required to have that to go to work. So if you feel a bit sick or essentially if they need you to have a COVID test on day 1, day 3 in the mines, etc. from there. Couple of changes affecting that was pretty much it for individual taxpayers. There wasn't a hell of a lot of a difference. Sometimes in budgets we see a big paper about how we're going to save tax rate thresholds changing, etc., etc. There wasn't a big deal of changes as far as individual taxpayers are concerned for the 2022-2023 income tax year. Couple of little things in the budget for businesses. One of the big ones that I saw was the skills and training boost. So essentially what it is the skills and training boost is there to support small and medium-sized business in upskilling their employees, and needs to be eligible expenditure for businesses to deduct an additional 20% on top of what they already paid. So essentially, instead of receiving a deduction for what you paid for a training expenditure, you add an extra 20% on top and get a deduction for that. So if you're a company, for example, 25% tax rate coming up, you'd receive 25 cents on the dollar back from every dollar you spent on training. This has essentially gone up to 30 cents on the dollar, with it going to $120 from there. So they are increasing the tax savings that you receive for giving your employees a skills and trainings boost. Big thing is they must be in Australia or online and delivered by RTOs or registered Australian training providers. Once again, essentially it's saying, well, okay, if you want to spend money on tax deductions throughout the year, as we know, people rush to do tax deductions at the end of June, they're happy to do that, but you need to spend it on specific areas, and they're really targeting skills and training boosts from there. And there's another one in essentially software, which we're going to go through now as well. So the technology investment boost is there to support digital adoption by small businesses. So much similar to the training boost, you can deduct an additional 20% on expenditure and depreciating assets that you spend in your business with a cap of $100,000. Seems like a bit of an accountant's worst nightmare, because we're going to go and pick out every time someone spends money on a tablet or a mobile phone or cybersecurity or cloud-based. But for the consumer, it's ensuring that they're encouraged to spend as much money as they can on technology and upskilling their business. The other thing that's been pretty popular in the last sort of 18 months is each individual government has had their individual COVID support grants. Bit of pressure on the federal government and the Australian Taxation Office to sort of come out and say, okay, these grants are either non-accessible or accessible, they're tax exempt, or they're non-tax exempt. So the government in the budget today has said all grants will be non-accessible and non-exempt. So essentially it leaves them out of your tax return altogether, which has been really quite handy to say, if you get a $10,000 grant from the government, non-taxable. Any deductions that you spend on it, you can get a tax deduction for. So it does help out a little bit with the COVID grants that you do receive from there. But essentially what it's saying is that there's no accessibility on the government grants that you receive. Boys, I think I've got an early mark today. I usually like talking about capital gains and all sorts of business structures like trusts and companies, but this federal budget has really done a couple of things. One is obviously the increase in low and middle income tax offset. And what you guys are going to talk about, which is a bit of cash for everybody and making sure that people with their superannuation are okay from there. So
yep.
I'll pass it on to Jake and let you go from there, mate. So just give me 2 seconds.
Yeah, you're right.
I'll get the meeting controls and can share with you. Mate, I'll just do the screens for you, so go for it.
Cool. Yep.
Yep.
Cool. Easy as. So we'll go to the next one, please, Pete. We'll start from there. All right. So essentially, there's been some new legislation regarding the extending of the reduction in minimum pension drawdowns. So this will affect, I suppose, most of our clients who are in pension phase. Essentially, the government extends the 50% reduction of superannuation minimum drawdowns for another year. So essentially, simply put, like, I suppose it's been the same in previous years. The reduced minimum increases your choice when it comes to how much you may wish to draw down on your pension accounts. So for example, if you're between 60 and 64, instead of having to draw down 4% per annum, you can instead choose to only take 2% of your balance. And I suppose if you're unsure about whether you should do this or not, please contact your advisor and we'd be happy to talk you through it. And I suppose the impact on your individual situation. So it's pretty simple. Again, this is as it has been in previous years. So there's not really much more to mention here. So next slide, please, Pete.
Yeah.
So this is the cost of living payments, which is essentially good news for a lot of people. Essentially, the government is offering a once-off payment of $250 to help those eligible to deal with the rising costs of prices and inflation. This will be paid to anyone in receipt of the payments or concession cards on this slide here. So I suppose a lot of our clients over 67 years old are likely to benefit, assuming that you're either receiving the age pension or hold a Commonwealth Seniors Health Card. So this payment of $250 will be made in late April 2022, which is approximately a month away. It'll be paid to the same bank account that Centrelink have on record, so you shouldn't really need to do anything at all to receive this payment. You'll just see it show up in your bank accounts. Yeah, and that is all for this slide as well. Thanks, Pete. Yeah. Lastly, I suppose there's been a temporary reduction in fuel costs. So anyone who drives a car would have noticed fuel prices have increased dramatically due to what's happening in Russia and Ukraine at the moment. To help fuel prices, our government have essentially halved the customs duty rate, which essentially is a tax on fuel imports. And the end result of this will be a reduction in fuel costs nationwide by approximately 22 cents per litre. So this applies to both unleaded and diesel fuel. And this legislation essentially just remains in place for the next 6 months. So the next 6 months, essentially, everyone Australia-wide will receive discounts on their fuel. However, I suppose it's important to note that fuel prices can still increase and decrease depending on supply and demand, plus the price of oil. All the government has done here is essentially reduce their own taxes in the short term to give Australians a bit of a break in, I suppose, the increased costs. And that should be all for me. Thanks, Pete.
No worries, Jake. Thank you very much. And Tommy now is going to go through some superannuation changes and also a bit of a reminder about some superannuation items that are coming up soon as well.
Yep. So these ones probably aren't as relevant to this year's budget, but just some previously announced legislation to take effect from next financial year. The first one's just, well, the increase to the superannuation guarantee, that obviously went up to 10% this financial year, and it's due to increase again up to the 10.5% from 1 July. I believe it's still due to continue increasing to 12% by 1 July 2025. So if you're someone that receives SG contributions like me, you're probably pretty happy about that.
Definitely.
Yep.
So yeah, probably that about covers that. If you want to jump on to the next slide.
Yeah, Tom, it's one that sort of gets overlooked by employers because it's not really out in the media as much, is it really? That effectively every year from now until 2025, it's going to jump 0.5%, isn't it? So it's a cost. Obviously, you guys are employees, so it's great to do it from an employer point of view. It's something which we all need to factor in when we're looking at budgets and things like that, that it is going to keep jumping up from there. And there hasn't been anything to say anything different. So, which I think is a great thing. Like, they've stuck to their word and they're going to keep legislating these increases going forward. So, make sure if you're a business owner to factor this in with your budgets and when you're employing people. Every little bit counts. We talk about the 1%ers and things like that. So 0.5% this year, 0.5% next year. They add up when you're looking at cost of employment. So it is quite important to remember that, that's for sure.
Cool. So the next one's just probably a bit of a bigger one. There might be some more advice for some of our clients off the back of this, but they're looking, it's going to come into effect from 1 July, the repealing of the work test. So currently, if you want to make any non-concessional contributions past the age of 67, you've got to meet that work test, which is essentially 40 hours in any 30-day period across the financial year. Going forward, they're basically getting rid of that. So you'll be able to make non-concessional contributions up to that $110,000 cap up until age 75. And then on top of that, they're also increasing the age limit for the bring forward rules. That's where you can bring forward up to 3 years of your non-concessional contributions up to $330,000 in a year. They're basically increasing the age limit on that up to 75 as well. So for anyone that's retired, I suppose, and not working, there's potential strategies that can be looked at there as well.
So remind me, Tom, with concessional contributions, is that 75,000 without a work test? 75 years of age without a work test as well, or when does that kick in from there?
So once you're past 75, you can't make any more non-concessional contributions.
That's correct, yeah. So that's for anything, isn't it? And they're sort of standardising that across the board, aren't they? Because previously it was different ages for different things. So just sort of all going, okay, age 75 and over, this is it, and making it easy to understand, I guess, isn't it really?
Yeah. Cool. Last one's just basically decreasing the age limit for the downsizer contribution. So if you're looking to sell your primary residence, you can basically add in an extra $300,000 outside of your other superannuation caps. Basically, they're just dropping that from 65 down to 60 to make it a bit more accessible, I guess, going forward.
Yeah, and I think that's purely to help the housing market out, isn't it, mate? Really?
Yeah.
Housing market's a bit tight at the moment, and I think they want to encourage more wouldn't call them elderly, but people who want to put money into super to sell their houses and to downsize as much as they can, which will free up housing stock for younger people, because as you know, house prices have gone a bit crazy, not just in Rocky, but Brisbane, Sydney, Melbourne. So yeah, I think that's purely based at, hey, let's just free up some housing stock by encouraging people who don't want to have a big house and want to sort of downsize, put in a super and get some tax effectiveness with their with their money from there. So,
Pretty much, yeah.
cool. One thing I wanted to mention, which didn't have anything to do with the budget yet again, was the instant asset write-off for our business clients. Essentially, the instant asset write-off allows businesses to claim an immediate deduction for costs relating to depreciable assets. So businesses up to $5 billion, which is all of our businesses here at Canals and most around the Central Queensland region can do it. And essentially, it's an immediate tax deduction for the cost of a depreciable asset. So previously, you'd have to deduct a tractor, which is in the picture, or a truck or something like that either 10, 12% or put in a general pool at 15 and 30%. As part of the COVID legislation, they sort of made that to be immediately deductible. So you get a tax deduction the minute you purchase an asset off the shelf effectively. That was due to run out in the 2022 financial year at June, but the government since legislated that to go to June 2023. So the immediate tax deduction for depreciable assets has been extended out for another year, which has been great news for most of our clients who are wanting to expand, but also get some tax effectiveness out of expanding from there as well. So that's been pretty good. Any closing comments, boys, on the budget? Thoughts? Anything that you thought was spectacular? Anything you thought, well, a bit dull? Obviously, there's a lot of infrastructure spend that we haven't covered here because obviously we're tax and superannuation accountants. But what are your thoughts as a whole, Jake?
Generally, I haven't made a lot of changes. But yeah, look, it's obviously a couple of small things that help a few people. So something's better than nothing. Look at it that way.
I think you've hit the nail on the head there, mate. It's a couple of small changes which affect the majority of the population, as in increasing the lower middle income tax offset. I think everybody on the pension or on a Centrelink benefit is going to get extra $250 as well, which obviously isn't covered through our budget recap with being a tax and a superannuation specialist. There's a whole lot of infrastructure spend, isn't there, really? I read today that the Queensland Rail is going to be expanded from Maroochydore out to Nambour. So I don't know if you've been on the Sunshine Coast, but you can't easily get a train to Brisbane, but they're planning on doing that, which is pretty handy. I think that they're going to spend a lot of money and they're not really wanting to tax people too much. So they're sort of making some savings in some areas, notably in obviously unemployment benefits, because unemployment is going to be 3.5% in the next couple of years. So whatever savings they've had by having a good economy, they're going to redirect that just to spend to try and make people happy. And well, in their case, they probably want to try and win an election, don't they, really? So that the least they do from a taxation point of view, the better. Question for you, boys. I don't know too much about this one. How long do you have to have owned your home to be able to sell it and use the money as a downsizer and add money to your superannuation when you've already retired?
I believe that it's 10 years and it only has to be partially exempt. So don't quote me on this, but I believe, yeah, if you've owned it as your primary residence for a chunk of the time and it's been an investment property for part of it as well, you're still potentially eligible for it.
Yeah, that's my understanding too, Diane, is that you have to have owned the property for 10 years, Tom. That's correct, isn't it?
Yeah, I believe so.
Yeah, so even if you lived in it as a principal place of residence for a couple of years, it has a rental property or had a business deduction hanging off the side of it, you have to have owned it for 10 years. Now, there's no requirement as to when you retired or when you didn't. It's essentially just a 10-year rule limit on owning the property from there. I hope that answers your question. Brent, I know we're missing you here at work. Have you got any comments on the budget? Any feedback if you're listening at all, or? Don't leave me hanging, Brent.
Can you hear me?
I can hear you, mate.
No, not overly. As you said, it was a pretty muted budget. They're trying to probably win a few votes and trying to balance out as you're saying, they've got a lot of infrastructure spend, but they don't probably want to spend a whole heap of money so as to not push up inflation, because that's probably the other issue they're going to be battling, and wages growth. So,
Well, that's exactly right. I think one thing you mentioned there was interest rate growth. Like coalition governments forever since I've been on, obviously following politics or following business when I was 15, they always bragged about having low interest rates. So I think the federal government of the day does not want high interest rates to their Brent, because that just goes against their ethos, isn't it? Really, they always say Labor's high interest rates, Liberals are at low interest rates. So they're being very cautious of that to a point, aren't they? Really.
yeah, and just obviously the inflation potentially coming through with on the back of these higher oil prices, that's going to be temporary, but it is having, you're just noticing a lot across a lot of the cost of goods, like building costs, all those sorts of things. While they're still temporary, it's pushing up inflation. So that's, potential, like, pushing up interest rates as well. So they're just I think they're trying to balance that out with trying to win a few votes.
I read something a couple of years ago that fuel and groceries account for, is it 40 or 50% of the total factor when they look at the consumer price index? Is that correct, mate? You know more than me about that. But it's huge.
Yeah, I'm not sure. They can manipulate those indexes as well to tell them what they wanted, the story they want to tell.
Yeah, but obviously these increased fuel prices is helping with this, with the CPI, that's for sure, and prices in general. And obviously there's floods down south, which is affecting supply chains, and then people out on COVID is also hurting product getting into certain areas, which is then pushing up the price as well. So they're really battling a few factors against them, aren't they? Really, obviously don't want to be a political commentator, but this budget's been very bare bones to be able to accommodate for all that, isn't it? Really.
Yeah, not many significant changes, hey?
No, not like we used to see. Which
Mm.
I mean, election year, you don't want to ruffle too many feathers either. So
Yeah, feels like they're targeting a few key areas for some votes there.
anybody who earns under $126,000 a year, bang, here's an extra $400.
Pretty much.
Well, it's easy policy for them too. Like, as I said, I don't want to get politically too much, but they haven't really done any tax reform in this. It's just been a couple of strokes of the pen and off we go next year. So I know they've just tinkered around the edges of a few things, and it's worked. So keep it going.
I think they've probably learnt from Labor's failings last time, whereby they lost the election trying to change franking credits and capital gains issues.
Yeah, well, Labor wanted to change the world, didn't they, really? So, probably don't want to be doing that in an election year either. So, Alrighty, any questions at all? We might wrap this up, boys, if you don't mind. Is that okay? Or
Yeah, too easy.
Yeah.
Good.
no, thanks for joining us on the webinar and podcast today. Thanks, Brent, for chiming in as well. Really appreciate your feedback. Also, a couple of newbies sort of helps us out as well. Get something fresh from there. So I'll just stop my screen share while I'm going. This recording is going to be made available to everybody who's registered for the webinar, plus on our YouTube channel. And then we'll also get it on the 125 Years in Counting podcast as well. So once again, this is all commentary from the budget last night. It's still to be legislated, but that's our take essentially on where things are sitting at the moment. It sounds like a couple of pieces of legislation have gone through today in Parliament already. And I saw something in the news before, which Labor said they weren't really going to block any of it anyway. So you'll probably take most of it as gospel, but obviously it has to be legislated before it comes into effect from there. So thank you for listening, whether you're live on the YouTube or on the podcast, and look forward to talking to you again soon.